Why don't we just get started? Good morning, welcome. My name is Steve Quazzo, and I'm here to moderate this panel. The less speaking I do, the better. We've got an all-star cast here from New York, from Boston, from Texas, and here in Chicago. So our goal today is to give everyone a perspective on the private equity world, the investment management business, the institutional business, share some of our thoughts and what we've been seeing out there. But first, I just want to publicly acknowledge our friends at DLA Piper. This is the 12th conference that they have put on for our industry. I think I've been to all of them. They do a terrific job. Jay, Sandy, Lee Miller, and many others. And I think it's a unique take on what's happening, not just in our industry, but in the world. And, and I really enjoy it. And I think we got over 650 people or so here today. So that speaks volume about the content. So thank you, DLA. And now that I'm done sucking up to our host, why don't I introduce the panel here. As you'll see in your program, we're at 80% participation on the panel. When you're dealing with Masters of the Universe, there are going to be some cancellations, and I just wanted to acknowledge Deb Harmon of Artemis, who can't be with us today. She regrets it. She called me on Sunday from the hospital. She broke her ankle in 3 places, and she was really, really disappointed. Len and I were talking about it last night. Some people will do anything to get out of one of these panels. But if you know Deb, email her, wish her a speedy recovery, tell her we're thinking of her. And she promised me that, like Derek Jeter, she will be back next year. So we'll get an opportunity to hear from her. But as I said, we're kind of really well represented here. So let me just introduce everyone real quickly. I think the bios are in the programs. But just to make sure you all know who's who, because some people are using their high school pictures. Let me start with Pam Herbst of AEW. She is the managing director at AEW and head of their direct investment group. She's responsible for all of the firm's investment activities on behalf of core and value-add clients. Pam oversees an asset and portfolio management of almost $16 billion in gross assets. Huge. She's a member of the firm's management committee, investment committee, and risk management committee. And she's been at AEW 30 years. So welcome. Let's see, I'll go right in order here. Chris Merrill, local Chicagoan here. Chris is the co-founder, president, CEO of Harrison Real Estate, private equity firm founded in 2005 that manages commingled funds and public securities products. Chris is on the board, chairman of the investment committee. They've raised a ton of money, close to $4 billion in discretionary capital. We're going to come back to that later. And his firm's, I think, a strategy is unique in the private equity area. I don't even want to call it a niche strategy. I'd call it a focus strategy. And they're very active in the education, student housing area, healthcare, and storage-related properties. They've acquired over 300, very quietly, over 300 properties, about $5 billion. And in the REIT securities business, they manage almost $1 billion of REIT securities. To my immediate left is Len O'Donnell. Len is president and CEO of USAA Real Estate. We've seen all your ads on television, so everyone knows. Right. Everyone knows USAA, San Antonio-based insurance company. Len oversees all of the operations of the real estate company, including acquisitions, the Global Investors Group, capital markets, portfolio management, as well as the staff functions. Len joined USAA in January of 2011. Previously, he was a principal and chief investment officer for a real estate opportunity fund called Crimson Real Estate Fund. And finally, my old friend Ralph Rosenberg. Ralph is the global head of KKR's real estate. He's been there since 2011. KKR needs no introduction here. Prior to joining KKR, Ralph worked for a couple of very well-known hedge funds, including his own, and prior to that was a partner at Goldman Sachs. Little known fact, Ralph and I started at Goldman Sachs on the same day in September of 1986. So it's great to have you here too. Thanks. So please join me in welcoming the panel. Right. And I guess I should say, I'm Steve Quazzo with Pearlmark Real Estate Partners here in Chicago. We're a much smaller private equity real estate firm. We sponsor commingled funds, separate accounts, invest in the mezzanine area, in the multifamily apartment area, and the value-add commercial space, office, retail, industrial, all in the United States. We started up in '96, a predecessor company called Transwestern Investment Company, and are today known as Pearlmark Real Estate. So I thought maybe just to sort of kick things off before we kind of get to the meat of our topic, we would just get a perspective on the economic environment. As Jay mentioned last night, it's been almost 6 years to the day since Lehman cratered, and we went into the financial recession or the Great Recession, lost all these jobs, many of which were allegedly have been recovered, maybe not as quite as high paying, and maybe there's some pushing on the statistics, but there's been obviously a recovery of sorts. It feels sluggish, it feels anemic, but the fact is that real estate prices are pretty much, we heard in the previous panel, pretty much back to where they were pre-crash. In most markets, rental rates, occupancies, low rates have certainly buoyed our industry. The lack of any significant supply has been kind of helpful. So, we're chugging along. The stock market's defying gravity. The REIT market's doing great. So, as we kind of look at our investment program, we're often having to defend to our clients, our investors, our investment committees, hey, why is this a good time to be investing in real estate, and how does the economic environment sort of correlate with that? So, maybe Len, you really oversee a big organization, and obviously you've done a lot of thinking and have a number of different products. How would you characterize the investment environment today, and how are you thinking about it?
Yeah, we obviously do. We've spent a lot of time thinking about the changes recently. So you go back 2010, 2011, right? There's this great buying opportunity following Lehman. And then, come around 2013, we started to tap the brakes a little bit, right? We said, well, interest rates are going to start to go up. There's still not a lot of job growth. Pricing's approaching peak levels. We've actually been more or less a net seller. We're still active, particularly in development, but on a pure acquisition versus disposition, we've actually been a net seller the last 2 years. We sat in 2013 and we predicted interest rates would go up in 2014 and the market would cool a little bit. Of course, that didn't happen. And now I think we're looking forward saying, okay, it's really going to happen in 2015. But we don't think interest rate movements are going to be significant. Maybe it's 100 basis points between now and the end of 2015 is sort of, I guess, the consensus thinking. I think the real challenge for us is, you're right, so pricing is just about back to peak in many markets.
Right.
There's still a real bifurcation in the country where there's a lot of secondary markets where there's no flow of capital and pricing is still well off of peak. I would say the biggest difference, I think, between now and 2008 is in 7 and 8, every market in the country was at historic peak levels. Today, it's more bifurcated than that. But I think the real challenge now, as we've sort of been cautious this last year and a half, is it appears as though the economy is actually gaining momentum. You're starting to see that there's a real possibility that we could see 3, even 4% growth over the next 24 to 36 months. And so how do we operate in a world where pricing is at peak and the economy seems like it's just perhaps getting in gear? Now, I agree with you. I don't think the economy is going to go into flat out, running at 100 miles an hour just because of the amount of government regulation, the amount of uncertainty in the world, all the, geopolitical issues that are impacting people's thinking. I think that's sort of going to continue to tamp down growth. But I don't think there's any question that growth is going to be higher in the next 2 years than it's been in the last 2 years. And your starting point for that is peak pricing in a lot of markets. So I think it's really challenging, but I think we're actually starting to get a little bit more optimistic about investing, just thinking that we're actually going to see real rental growth real absorption, or I shouldn't say going to, we're actually seeing it already. I think it's going to accelerate, particularly in office and a couple of other sectors, which have lagged.
Right.
The hotel business is picking up. So I guess if you ask me to summarize, what does all that mean? I think we're more optimistic probably than we were a year ago, but still really nervous about pricing because a lot of it is still driven by low interest rates and easy money, as they talked about earlier this morning. And that is eventually going to start to change. Conversely, the wall of capital that's coming at the U.S. from abroad shows no sign of slowing down. So, you wonder how much impact interest rates are going to have. We'll talk more about that later.
Yeah, we're definitely going to come back to the capital raising. So that's a balanced, relatively bullish view, which is good. Pam, what's?
We're pretty much the same. I mean, we take a look. Last year, we kept, focusing pretty heavily on interest rates and where they were headed. And as a company, we're still taking a position. We're agreeing with the Fed because the consensus is rates are going to go up, although it doesn't necessarily feel that way. I think we're thrilled that we believe now we are in an expansion mode, that most jobs have been recovered. If you really go through by a number of markets, jobs are back above prior peak.
Do we feel that they're high enough paying jobs, that they're white collar jobs, or are they burger flippers? I mean, or government workers?
Yeah, I think it's a combination, but for us, most of the markets we focus on are markets where there are high education levels, they're very dense, there are jobs primarily driven by energy and tech and healthcare. And because when you take a look at our money, particularly on the core side, if you really look at where we invest, we continue to invest in most of the core markets across the U.S. because for us, liquidity is really important. So in those type of markets, there are jobs, there are educated people, and so we're not really going into the markets where you are concerned that you have burger flippers and really low-paying jobs.
Okay.
But we also think that we are going through a major renaissance with energy. 10 years ago, I know in the earlier panel, they asked, where would you invest today you wouldn't 10 years ago? 10 years ago, we wouldn't invest in Houston because we thought, it's really a one-horse town. And today, we're actually quite bullish on a Houston. We're quite bullish on a Denver. We're really trying to understand what the demographic changes mean throughout the U.S. And we're seeing some even smaller markets where we're seeing young people want to live. We're also excited by the fact that supply has been pretty muted.
Yeah.
A lot of people are focused on excess apartment building, but when you take a look at the percent of the stock that's actually being built versus where we think the job growth is going to be, still looks pretty healthy. And then you look at office, retail, and industrial, and for the most part, they're nowhere near what they have been historically. Right. So we're hopeful that we're going to see better rent growth even than what we're underwriting.
Okay, good. That's maybe a good lead-in, Ralph, to you. I mean, KKR has obviously done a lot in energy. You've made some energy bets through your real estate activity. You guys also have you run operating businesses. You have a sort of a global view. What's your sense of the big picture?
Yeah, I'd make a couple of observations. Number one, we own about 90 operating companies globally. And on average, the feedback that we're getting from those businesses, which are diverse across all the major industry groups, is that economic growth is back and it's real, and that we're seeing fundamental revenue growth at these, call it 90 platforms. And so there's a look through the real estate business, which I think echoes some of the earlier comments. So that's one comment. Second comment is that given the situation from a macro perspective in Europe, our house view is that the US Treasury rate will stay low for longer. Because when you have the Bundesband trading at 94 basis points and Spanish 10-year yields inside of the US 10-year, and Mario Draghi just starting to think about unnatural ways to stimulate the European economy, from a global flow of funds perspective, it's hard to imagine a situation where that continues, but the US Treasury rate goes up. In fact, there are some, including our internal economists, who think that our Treasury rate might continue to compress relative to European rates. So what does that mean? It means that we might be in a situation where the short-term rates in the US are going up because the Fed effectively is responding to economic growth, but the curve might actually be flatter by definition based on what I said about the 10-year. So the implication to look through to the real estate space in the US is that I actually think that we could be in a very benign, levered real estate environment for longer than many people expect. I think we could be looking at sort of similar dynamics in the industry for the next 3 to 4 years, not the next 1 to 3 years. And so that's the backdrop upon which we look at our investing activity. I will say, however, that we do underwrite all of our deals expecting cap rate expansion. So that really means that you have to be doing something fundamentally at the asset level to effectively create real NOI growth that could compensate one for a 50 to 75 basis point cap rate expansion in the back end. So long story short, we are not core plus buy and hold players because of what I just said, but in the value add and opportunistic space, we have been able to find opportunities that fit what I've described. But in the US in the last 9 months, to put it in perspective, we've been blown away in most of the things that we've been bidding on. And the only things that we've closed on in the US are energy related. We're doing a development deal in Midland, Texas, for example, that we can talk about if you're interested. But we do see this wall of capital, and for guys in my business, you're only as good as your investment returns, and we're not stewards of capital to like get market exposure for clients who want market exposure. That's not how we position our value add to our clients. So we could sort of be watching a market where things look really interesting for a while, but we just get priced out of it.
Okay, well, we're going to come back to the real deals and some of the walls of capital, and I didn't know where we were going, but you're starting to hear the counterpoint to the Mike Fascitelli, sell, sell, sell. So far you're hearing buy here. So Chris, follow up, tell us where they're crazy. What do you think?
Well, I mean, I guess I'd say our firm, we had the ability to kind of create a blank sheet when we started in 2005. And the idea was to try and get away from trying to time markets. That's very difficult. Where are we in the cycle? And that's a real defect for limited partners if you time the cycle wrong. So we spent a lot of time, and again, we had the good fortune of starting with a blank sheet and said, let's try and find asset classes that we think have underlying need-based fundamentals, are very much focused on demographics. It almost becomes sort of social infrastructure type investing. So we focused on education, student housing, both on and off campus, healthcare, medical office, senior housing, and self-storage assets. And for us, what's nice is these industries really, we look out over the next 10, 20 years, and there's a strong need for it. There's underlying demand for these asset classes. They're hard to access, smaller deals. You can absolutely make mistakes, as with any asset class. But they're ones that really for us, when we started our business in 2005, 2006, 2 years into a business, here you've got a huge market downturn. I think it almost helped our business model. I think we were lucky in the sense that the asset classes that we were involved in were very resilient. We didn't make a lot of money in the downturn, but the occupancies of our properties held up, and you could really see that need. And now you're seeing more institutional interest in these asset classes, and the challenge is just access, and the markets are only so big. So what's nice for us and for Air Street is it's not really about timing where we are in the cycle. It's looking at sort of the macro fundamentals and saying, okay, what's happening in healthcare, what's happening in education, and that's more where we spend the time as a firm right now. But there's both great buying and great selling opportunities within the asset classes we're in right now. So it's a very interesting time.
Right. So you raised demographics, and I think that's an important kind of macro trend. I don't know if anyone else kind of wants to comment, but obviously we have a lot of millennials or Gen Yers going through the system, whether it's student housing or multifamily apartments, and that seems to be a tailwind of demand. We have greater urbanization, greater diversity, an aging population. How do you guys sort of think about those macro trends? How do they impact what you guys are doing?
I'll just make one simple observation, which is everything that Steve just mentioned has impacted how we think about the office sector. And basically, we are not at all interested in having any exposure to suburban office. The office product that we are looking for exposure to is very efficient floor plates with high ceiling heights and open architecture available to optimize the efficiency of how firms today, whether or not they're service firms or corporate divisions of industrial firms, utilize space. So long-winded way of saying that that would be the one takeaway that I would have in terms of thematically where we've decided not to play relative to where we do play.
You're not alone. It's lonely out there in suburban office land.
And we, on the other hand, have done some suburban office. And, I mean, generally speaking, we'll invest in downtown urban areas, but we do believe that certain suburbs are still going to have demand. There's still going to be people who are going to work in those buildings, particularly when you start looking at technology companies and life science companies, and you have workers who are in their mid-30s with kids. They don't want to come into the city. But what we have learned over the years is you have to have very amenitized suburban office projects. So it really does have to be a place where people can work and they can go and find good restaurants and really want more of an urban environment within the suburbs.
I was going to say, I think.
But they're very selective, you know.
I think that's a great point, though. So you're really not saying that different, right? So when we think of the traditional suburban office parked at an interchange, at a highway interchange,
Right, forget it.
you know, that business is dead, right? And it's 20% vacant today. It's going to be 20% vacant forever. So what you're really talking about is suburban office in what is a mini urban environment.
Correct.
And I think that you're right. There are separate demand drivers
Right, and I
there.
think you have to look at every city, and you have to look at how close in the suburb is, because if you compare a Los Angeles to a Boston, what's considered to be suburban in Boston would be part of downtown Los Angeles, just based on size. So I think each market's a little different.
We actually think if the recovery takes off, you're going to see a surge in office development, because even though you see this 16, 17% vacancy factor hanging on, we think half of that or more is functionally obsolete space that's just not going to satisfy the modern user. But in terms of the demographic, I mean, if you're not paying attention to the transition of 10,000 seniors retiring every day and the growth of the millennials and the changes, as Sam Zell referenced before, in household formation now pushing to 34 years old, I mean, you're going to get lost in this business. Right, so demand. That's why we like AEW. We started saying in 2011, 2012. Oh boy, maybe there's going to be too much supply in resi, and we better slow down development. But that capital, one, there's not enough capital poured into that market to overbuild it, and two, the demand has continued to outpace the new supply. Not in every market. There's a couple of markets that got out a little over their skis, but nationally, the millennials continue to absorb, and a whole litany of them haven't even left their parents' basement yet, right, as they start to find jobs and the like. So I think that continues. And I think on the other end, the healthcare side, when you look at the baby boomers aging and what's coming at the country, both in terms of lifestyle choice, right? Some of them are moving urban, moving back into apartments and the like. But then the healthcare side, in terms of what they're going to need and what their demands are going to be, I think those are overwhelming trends that we're spending a lot of time trying to figure out how to be part of. And then you've got, it's the barbell, right? You've got those two, and you've got a much smaller cohort in the center. And what do you do about that when their next generation is going to be smaller? Right, so we're going to build all these. I worry sometimes I won't have to deal with it because I'll be long gone. But we're building all these apartments for these millennials, and then the Gen Yers, kids are going to come along, and it's going to be half the size. So who's going to live in those apartments? But I'll let somebody else worry about that. So.
It's good. Good. So before we leave the economic topic, I just, the twin towers of real estate, interest rates and inflation. We haven't talked about inflation. Doesn't sound like anyone's really concerned right now, but traditionally that was one of the reasons to invest in our asset class. Any thoughts on that? How are you protecting against it?
I mean, I can tell you, investors are concerned. I mean, I can tell you there's not a meeting that I'm not in where institutional investors are not concerned about inflation. Is it going to happen 6 months, a year, 2 years? I don't know the answer, but it certainly comes up in terms of looking at where do investors want to place capital in the coming decade. So it's something that's top of mind with a lot of investors.
Actually, I think the best proposition for our industry is that if you can underwrite deals where your growth expectation is no better than what effectively the consensus growth expectations are, and have an embedded inflation hedge, if indeed inflation kicks into the higher gear, that will ultimately trickle down to the economics at the asset level, that's how we sort of discuss with our investors sort of the value proposition of what they're getting through the real estate product. And then there's this whole other discussion around the relative value of the real estate product to other assets that people can put into a portfolio, which I think on a relative basis, real estate stacks up in today's environment quite well.
Well, I think that's the risk too, is why is multifamily cap rate so low? I think people are pricing in the expectation of inflation and real aggressive rental rate growth, and maybe they'll get it, but I think some of the challenges when you look at some of the prices that are being paid, people are assuming they're going to get above average revenue growth.
I think it's partly that. I also think people have come to the realization that multifamily consumes a lot less capital than other product types, right?
And you can finance it more efficiently.
Hotel. I'm sorry?
And you can finance it more efficiently.
Right. But, so, yeah, we're pro-inflation.
It's part of the conversation. Okay, I want to get out there. Okay, let's transition, since one of the two key themes of this panel is capital raising. And I think it's, Chris, I'm going to start with you, but I think it's been no secret that, it's been tough raising capital over the last 5 years. I mean, unless you're, Blackstone or you're a non-traded REIT sponsor. And so, you guys have been successful. Actually, everyone on this panel has been, but Chris, I want to start with you because you're kind of started out as a little guy, big guy now, but, $4 billion over the last whatever. Just talk about, is it easier today? What are some of the success factors? What are you seeing out there? Give us a view.
Okay. I wouldn't say it's easier. I think
it's never easy.
No, I mean the difference between when we started now, I think it's harder now from a regulatory compliance standpoint. So that's what keeps DLA and all those guys able to throw these big conferences. But the regulatory compliance back office level of due diligence that is undertaken by investors is I've never seen before. You'll spend time with the CIOs and go through your investment strategy for an afternoon and then spend a week with their back office team reviewing your back office team. So I think it's very difficult to pick up and start and be a first-time fund in today's environment. There is absolutely capital out there. There's no doubt about it. All of the investors that we're talking to and speaking with are increasing their allocations to real assets with a concern of inflation, rising rates. These are things that are on everyone's top of mind. So when you look at the percentage of capital that's looking to get into real estate, it's out there. What's been lucky for us, we've been very lucky and very fortunate, is that we had a little bit of a different strategy. And the strategy we had is very focused. So it allowed us to offer a diversifier. We didn't have to compete with a lot of the folks up here. We really could be a product that could be part of a portfolio. We're not in the main cities. We're in a lot of what people would view as tertiary, secondary cities, but near good universities or good hospitals. So we were fortunate that we had a differentiated product. And then I think what happened in the downturn, I think, it really showed who really had the platforms that could stay, who had capital, who was investing in their infrastructure, who was investing in their people. And I think it cleaned a lot out of the system in the downturn. So, I guess long way of saying, I think there certainly is capital out there. I think everyone needs to have the right infrastructure in place, the right team, the right alignment, the right sponsor capital to ensure that that you can be patient going forward. But I think it's an exciting time because the capital is now looking for yield and looking for alternatives. So you're seeing investors that we spoke to a decade ago about some of these asset classes. Senior housing, student housing is not considered that different now. And now you're seeing capital start to look at very interesting things. So, I think there's going to be a lot of innovation over the next decade. And I think capital is going to be receptive to it because when you look at the alternatives right now and you look at the yields that you can get in some other asset classes, it's a nice diversifier to a portfolio.
Some of us are old enough to remember when multifamily apartments weren't considered institutional. So
Exactly.
Now we've got student housing, we've got all kinds of different areas.
I mean, the core Odyssey Index multifamily wasn't part of it. Now, our asset classes aren't part of the Odyssey Index, but I think that's going to come.
Yeah, or hotels. I remember investors saying no beds. We'll invest in anything but no beds.
Yeah.
Other views on capital flows? The wall of capital coming? Where's it coming from?
I'll give you two observations. One is that I do believe that there is a lot of capital looking for a home in real estate today, and that the capital is just trying to match itself with good stewards of capital. And so I think the credibility that was lost by lots of managers during the crisis, as was mentioned, has played to the benefit of all of us who have effectively endured that situation. I would also say that the denominator effect, given that the stock market's at all-time highs, people cannot get their real estate allocation to an appropriate level from a traditional portfolio diversification perspective, and so that's playing quite well into the industry. On the topic of non-traded REITs, I think the jury is really still out on this, even though there's been this incredible wave of capital raised there. As the SEC is now changing the disclosure requirements, it will be interesting to see whether or not the non-traded REIT business is a push product or a pull product. Right. And to date, it's been a push product because effectively 11% of the capitalization is paid to intermediaries to raise the money, and effectively it's being pushed on investors to effectively invest in these products. Now when the disclosure is going to be more transparent, we're going to see whether or not it's really a pull product where investors really want this product and they want it, but they're not willing to pay 11% to get it.
It's defied gravity for a
Correct.
long time. I mean, just to put some statistics on it, $13 billion was raised in 2012. 2013, $19 billion was raised through the NTR channel. This year, they're on track to do another $19 billion. So, we're not talking chump change here, and many of us in the institutional world have kind of been predicting the demise or the leveling off. Well, we'll just wait till this XYZ institutional management firm gets into it, when they reduce the load. Guess what? They didn't sell any product. So it'll be really interesting to see whether they're able to continue to navigate it.
Absolutely.
So, but it's been a huge boon for those in that area, and they've been a big buyer of real estate.
Well, and then you've got the foreign capital flows. I mean, the amount of foreign capital now looking at the U.S. is amazing.
Yeah, so talk, Len. I know you spent a lot of time with Brad and others.
So we, we're having a lot of success in that arena, but I think right now the challenge is one, finding. I mean, we're actually tamping down our fundraising efforts just while we look for opportunity in the market, right? I mean, we don't want. I think Ralph said it earlier. Our job is not to push capital out the door; it's to find good investment opportunities. And we just don't think that there's an alignment with the amount of capital coming in, particularly from abroad, and the amount of great opportunities in the market. And I don't completely disagree with Mike, by the way. I think it is a great time to sell, and we've been a net seller, as I said. But I just think looking forward, we do get paid to invest, right? So we have to find places where we can add value, where we can create value as rents rise and the like. And but that said, the other thing that tempers foreign investment is FIRPTA, right? So if we're constantly trying to find the domestic match, or the sovereigns have the advantage of some structures available to them that let them go up above that 49% range, but there just isn't as much domestic capital as there is foreign capital, and that slows the rate of foreign capital inflow. And that's probably, I hate to say this because I'm not a fan of FIRPTA, and Jim Fetgetter would probably fall out of his chair if he's in here, but
Jeff DeBoer is here somewhere. He promised me he's going to change it single-handedly.
But frankly, right now, I think it may be tamping down the amount of capital flow, which may be helping the marketplace a little bit. I mean, if all the foreign capital that wanted to get here could come here unfettered, I don't know where pricing would be.
Well, it's interesting. I think there's a lot of domestic capital looking for a home. I just think domestic capital has a slightly higher cost associated with, whether it's the pension funds that have a little higher discount rate. I mean, we're seeing, a lot of foreign capital from places we've never seen before. I mean, here in Chicago, Korean institutions have probably purchased 3 or 4 buildings over the last couple of years. We've had our, couple of, Chinese investors who bought 2 assets on Wacker over the last few years. Chase Plaza in downtown Manhattan was bought directly by China. So different places that we hadn't seen. I mean, obviously Canadians have always been active.
Remember, some of those people, particularly the Koreans, were large fund investors in the last cycle.
Yep.
And they got crushed in those funds, so their immediate response was to buy direct this time around. That's starting to change back. They're starting to realize that they can't invest the amount of capital they want to invest on a competitive basis in all indirect investments. They're going back into funds. But a lot of those new faces were sort of underlying before. But I just want to touch on what we were talking about earlier, was mentioned earlier about how the burden that's come into this in terms of due diligence and reporting and everything else. And I think that that's going to continue the trend. You're going to see the trend continue to consolidation in the manager business. It's really, really hard for small, and I know this is somewhat self-serving as a large manager.
I was going to get there. I want to ask that question.
But it's really hard I have a number of friends that run, and I used to run a small opportunity fund, and if you have $500 million, $1 billion, $1.5 billion under management, it's really hard to sustain the infrastructure you need to survive this fundraising and I'm sure you saw it as you grew to $4 billion. Yeah, exactly, right? I mean, the demands are really overwhelming, and you know, you've got the consultant community in the mix, which adds to that burden. And I just think it's a really hard business model for smaller managers.
So let's talk about that a little, because scale is
for us, we have the benefit of a 30-year track record across the private equity side, and we raised about $2 billion last year. We're on track to raise probably another $2 billion this year. That's across different products, so opportunity fund, senior housing fund, open-ended core fund, separate accounts. But even with a strong track record and even with repeat investors, the level of due diligence that they conduct is just crazy. And my partner, Mark Davidson's here, who runs the Opportunity Fund, and we're just talking about it, just the amount of information you supply, the way you have to slice and dice data, and these are with investors you've already delivered performance to. So I'd say it's very, very difficult. In terms of the types of capital, we have both domestic and foreign. Our open-ended core fund structured as a domestically controlled REIT, so that works for foreign investors. I'd say one new trend we've seen in the past couple of years that seems to be increasing is the amount of money coming in from high net worth individuals through banks. And they seem to have less due diligence than the institutions. It's actually a little refreshing. Right. But they're looking for both current income yield and appreciation. And they're looking at it because they can't get anyplace else.
Right. That's a great channel, obviously. But so let's hit the scale thing one more time just to make sure, because we've seen a lot of entrants. You know, first it's been the big buyout firms, right? You know, Blackstone, KKR, you know, TPG, a lot of those players. You've got now the big insurance companies who've all gotten into the third-party business. You know, your competitors out there, you know, MetLife, TIAA-CREF, huge consolidators. Obviously the traditional real estate managers, the AWs, the Heitmans, the JP Morgans. So, you know, it just intuitively to me seems like, look, real estate's a local business. You know, there's a long history of entrepreneurial firms in the investment management business. There are examples in private equity and hedge fund. I mean, do we really think the little guys are dead?
It's hard. I mean, I always find funny is the emerging manager conferences, and you know, there's all the, you know, we all know about the emerging manager capital that's been allocated by some of the big state funds, and you ask who's actually gone into a first-time fund, and it always cracks me up. You know, they've got this capital set aside for an emerging manager program, yet the due diligence they're doing, there's no way that emerging manager really could have the infrastructure associated with it. So I don't think it's dead. I think it's very challenging, and one needs to really have a strong capital base to get going. I think it just takes a very big investment nowadays to start an investment management business. You know, and I always talk about, you know, we invest with operating partners, and I'll talk to an operating partner that'll say, hey, we're just going to go raise our own funds. And I say, you know, go for it. You know, have a good time. You'll really enjoy it. And I think that's the challenge is, you know, these guys trying to raise a $200, $300, $400 million fund. You know, the cost benefit, because at the same time we're getting the pressure on reporting back office, everyone wants a different way you report something, the fees are coming under pressure. So they're busting your chops on fees and pushing fees at the same time they're requiring more from your organization. So it is a challenging environment. Now, that's a barrier to entry. You know, I think, and I try and say that to our firm, that, you know, let's deal with these challenges because that is a little bit of a barrier to entry. But it does take a lot today, I think, to start these businesses.
I was just going to add two things to that. One is that when you think about all the operational complexity that was already described, coupled with this anxiety that in a commoditized business, which the real estate markets are it's a commoditized product. The information is available. Any of us can underwrite reasonably well an asset in most every major market where you can pull data and Reese reports and all this kind of stuff. That when an investor gets presented with a first-time fund, it's hard to differentiate why that first-time fund is going to make a difference in their portfolio. And by the way, I would say the same thing if we were sitting I used to be a partner at a hedge fund. I would make the same comment about somebody who's about to start a hedge fund. So ultimately, given the maturity of our industry and given how much exposure investors already have to players in the industry, to be included in a portfolio as a new entrant, you better have a really differentiated story to tell, or else you don't really have a shot. And by the way, the reason I ended up at KKR, because I thought about all these issues, is because KKR had a balance sheet, and I knew that we could seed a fund with, we have a $1.5 billion fund. We seeded with $400 million of our own money. Okay, so that showed alignment of interest, and so and we have all the operational stuff checked the box also. But that was the big differentiator for us, that we could show up with our own capital and make it feel a little bit more like you're co-investing alongside of KKR as opposed to us, being an asset manager where we're putting in a couple percent and running a big portfolio. So it's really hard. You have to. We all play to our strengths, right? We all sell a concept or a differentiated element of what we have, a 30-year track record. I've got a balance sheet. You've got this distinct niche investing in these really interesting, defensive businesses. You've got a huge breadth of relationships and tentacles, whatever it is. But the reason we're able to be successful is because we have these things. If I were just Ralph Rosenberg trying to start, first-time fund, to buy office in the Southeast, forget about it. I might as well just play golf.
Well, two things. First of all, I don't think it's impossible for the small manager to raise capital. My point is it's a very difficult model in which to make money, right? It's a very difficult model to sustain, right? So if you go out and raise you might bang it out and raise $250 million. You're not going to make any money running a $250 million fund, right? So that's part of it. But the other thing, back to don't want to leave your one point about it being a local business. I absolutely believe it's a local business. And I think, and I'm sure it's true of everyone up here, one of the cornerstones of our platform is great local operating partners. There's a couple of them in this room for us, right? And I think that's where the difference is, are they fund managers or do they stay as operating partners? And personally, I believe they're going to be much more successful and make more money staying as operating partners than where we were, as you said a few years ago, hey, I'm going to go out and raise my own fund. I've had a number of them that did that come back to us and say, we're good operators, we weren't very good fund managers, so we want to just raise capital with you guys again. Well, and that, I think, is the successful model.
Well, the irony of this comment is twofold. Number one, coming out of the crisis, LPs became disenchanted with asset allocators, like guys who do what I do, where you pick operating partners, because people felt that they weren't disciplined enough during the crisis, that we gave that capital to these operators and we didn't sort of turn off the spigot. And so therefore, they wanted to go directly to the operators. But if you look at the operators who actually were both operators and ran institutional money during the crisis, they didn't stop spending the money either. In fact, when you give money to a guy who's a Southeastern office guy with discretion, that money's going out the door in Southeastern office. I don't care what anybody says. So it's a little bit of a catch-22, and I do think the balance will be, hopefully people like us and many of us in this room who can sort of put the gas on, put the brake on, and be a little bit more disciplined the next time around, and be able to be stock pickers in the real estate space with respect to who the best operating partners are and where thematically we should put capital, like to your point.
Well, I mean, how many times have we all heard the double fees? And, Jesus, allocator versus operator, double fees. And, then they realize that, okay, if I'm in an operator-only fund and it's a small guy, now I'm taking additional risks like recourse risk and entitlement risk. And so I don't think until we had that downturn where a lot of those issues jumped out that people recognized the risk associated with trying to kind of go into a smaller platform like that. And, when's an operator going to fire themselves?
Well, they're not fiduciaries, so that's the difference. I mean, we were a huge beneficiary of that mess, so.
Absolutely.
Yeah.
No.
By the way, it's hard to get exposure, too. I mean, you talk to any of the big sovereigns who said they wanted to go direct to the operator, and then you ask them a year later, like, are you underallocated the real estate? They're just more underallocated because they couldn't find the operators and they just didn't have the people on their staff to find the operators and to vet the operators and to do the diligence. I mean, it's really complicated to run a business where you're going direct to operators unless you are really scaled with a huge staff.
Think we hit a nerve here? I think this was good. I think I think it's a great takeaway for everyone in this room. We got a lot of great investor operators in here, and I think the takeaway is don't go raise a fund. Cozy up to one of these guys with money. Get investments done on a one-off, non-collateralized basis,
Yeah, a
and
little
you
self-serve.
can do a lot
Yeah,
better.
it's a little
So,
self-serve.
okay, before we move on capital, is Jay Epstein in the room? Okay, Jay, I want the record to show that I raised crowdfunding as a possible capital raising strategy. I'm not saying I advocate it. About 100 million, maybe 150 million has been raised through crowdfunding. I know a lot of young people are working on it. There are lots of Silicon Valley analogies, Lending Club, for instance. Who knows if this is going to be a source of capital for our industry? Jay seems to be convinced that it will be. Maybe he's right. I spoke with a young team that's actually out in Vegas this week at a real estate crowdfunding conference. So I don't know if anyone has a view or questions in the audience, but I wanted to raise it because
Sure.
Jay wanted the whole panel to be on crowdfunding.
I think it's just a fundamental question around reputational risk that you want to take if you're in that business. And, I think probably, I don't want to speak for my peers, but I would think reputational risk is something we all talk about and think about every day. And a little bit of life's too short. We've got great institutional businesses and they're scaled. Why would, in my opinion, we're not going to screw around
God,
with that.
my client service guys would kill me if I had 10,000 of these investors
Yeah, right.
calling with
That's
questions.
hard
I don't
to
know how you.
manage.
It's hard to manage.
Yeah, I don't know how you manage it.
Someone will figure it out.
So in the 1980s, we called it syndication.
Right.
And I think
And that didn't turn out
when the
very well.
regulator sees, if it ever attains real volume and the regulators see thousands of private investors going into these things, the regulatory hammer is going to come down and it's going to declare itself one way or the other. So I don't think we're going to be a leader in that space.
I agree.
Good. All right, so let's move to sort of the second part here of the meat of our topic, which is chasing deals. I never liked that analogy. It's more like seeking investment opportunities would be more appropriate. And Pam, let me start with you. I was telling Pam I was speaking with one of her senior investment guys about a week ago, and who represents the separate account and the open-ended fund business. And he said that AEW was on track to do $3 billion this year in new investments. And that just, as a little guy, that just blew me away in terms of volume. So talk a little bit about how you're able to get that done in this environment, which is incredibly competitive with walls of capital coming from everywhere. And then we'll sort of open it up and get everyone else's perspective.
So we're on track to do about 3 to 3.5 billion gross. So about $2 billion.
So he wasn't
of equity.
boasting. He was telling the truth.
So in addition to capital raised, we have to redeploy capital on separate accounts because we're going to sell $2 billion of product this year. So probably 60% of that is core, and about 40% is what I call non-core. And on the core side, it's pretty much competing with everybody through the entire broker network. And the success ratio, we go back and look at the numbers over years. It's probably 8 to 10%. So to do $1 billion worth of acquisitions, we're really underwriting $10 billion worth of deals. So that's not just having packages come across your desk. That's really having the team go through and do all the financial review and basically bid on properties. In order to do that, we have to be pretty efficient. So we really do start with a top-down approach on the markets we're looking at. So we're not just randomly out picking up the phone, looking at deals. We're very focused on markets. For the most part, we know the markets very, very well. But it's tough. For the 40% that's non-core, most of that's really done through operating partners across the country. And again, we have relationships with some folks for 30 years, people who have spun out of those businesses. We do business with some new folks that come out of different companies. And for the most part, the non-core is done through operating joint ventures. And it's been very successful business for us.
Great. You guys?
In the U.S. this year, I think we might have invested $150 million of equity. We've only done 2 or 3 deals, and one of those is committing to a development deal in Midland, Texas, where we committed about $45 million of equity out of that 150. It's been hard to find good deals in the U.S. for us, for our mandate, which is to try to find value-add and opportunistic deals where you're not trying to leverage with more than 70% leverage, which is our mandate. In Europe, we've probably put out an equal amount of equivalent euros to dollars, and it's really in 2 or 3 deals. It's hard. I mean, there's a lot of money chasing deals, and so we haven't been net sellers because I believe that what's happening here is that the core and core plus cap rate compression is really what people like I want to sell into, and so I want to get the asset stabilized to a level where we're getting paid on the sell for creating that stabilized NOI, and so we're still a handful of months away from doing that with a number of our assets. But in the interim, we've been aggressively refinancing. So our ability to put out capital has been tamed a little bit given the competitive environment, but I'd say we've done a half a dozen incredible refinancings this year and taken out a lot of equity in doing that. Yeah.
Well, so start with what it isn't. So it isn't 2011, right? We did about $2.1 billion of straight acquisition and some development in 2011, probably $500 million of development commitments. And then that is sort of, and that's declined as the last several years have gone on, as I referenced earlier. That we probably did $1.2 billion in 2012. We did about $800 million or so last year. This year, we might find our way to about $1 billion of what I would call straight acquisition, but most of that is non-core. We're buying, vacant warehouse buildings, or we're buying office buildings where there's 20% vacancy. We think there's below market rents. There's work to be done. A little bit of core, like in our government building fund and our Eagle fund. But even that is usually core with, I got a term when I was in London last year, core with a scratch. I kind of like that term. It's not pure really value add, but it's got a little bit of a story to it. Maybe there's shorter lease term expirations than the real aggressive market wants to buy.
Yeah.
Things like that where we take a little bit of real estate risk and get a little bit better pricing. We're going to sell $1.5 billion for the second year in a row. And so we're, as you say, we've got to redeploy some of that capital. And what we've done is really just kind of broaden the appetite rather than go deeper into one space. So we're doing a lot of development. We'll commit over $1 billion in development. That's including, the build-to-suit business and office and industrial. It's spec and industrial, a little bit of spec and office, and meaning some pre-leased projects, 50, 60% pre-leased stuff in good markets. Multifamily continues, we continue to be active. We've shifted a little bit in multifamily to a little bit from a build and sell or tactical strategy to a little bit more build to core in places like New York and San Francisco, where we think they'll endure. And then, on the debt side, we're doing more stretch first mortgages, mezzanine space through our Square Mile affiliate. We've started a whole loan program. And I think what that does is it gives us exposure to what I really think is the biggest opportunity facing us, and that's the continued recapitalization of our industry. I mean, I know everyone's tired of hearing about the $1.7 trillion in debt that's maturing over the next 4 years, and I've had people say, oh, that's over with, there's plenty of capital in the market. And there is plenty of capital in the market. It's not 2007, 2008 again. There's not another Lehman Brothers coming. But it is an opportunity because, we're doing stretch first mortgages. We're creating mezz pieces, at 80% in the cap stack and getting paid 1,000 over, right? That's not an efficient capital market, right? That's not a market that's fully cured because we're financing inside those pieces. We're refinancing old seniors, right? And we're carving a 20% mezz piece out of those and getting paid 800 to 1,000, 1,100 over on hotel business. So that's opportunity, right? And so what we've kind of done is broken that $1.7 trillion up into 3 tranches. There's the piece that the senior market is going to consume very handily. There is plenty of money in banks and life companies, and not as much as people thought, but CMBS is still out there. And that'll take care of a piece of it. And then the mezz business is going to take care of a piece of it. And then you've got to recap the last piece as some form of equity, whether it's preferred equity, whether it's sales, whatever. And that's, I really think, just heating up. I mean, we're seeing that moving into the second half of this year and into 15, 16. We're in the middle of 4 very large recap deals, all north of $1 billion, all with foreign partners. And we think the yield opportunities are better than anything we've seen on the acquisition market. So I'm kind of wandering a little bit, but I think, so we went from this great buying opportunity in 11, and then I think in 13 and most of this year, we've been kind of focused on doubles. I don't think there's there's no low-hanging fruit out there. So we're trying to figure out where we get good cash flow. And then on the disposition side, I agree with you that you don't want to sell everything right now. But we're trying to focus on what was sort of tactical. What, if we're going to head into another downturn, whether it's in 2 years or 3 years or whatever, which assets in our portfolio are going to weather that downturn well? And we want to hold those and circle the wagons. And those that we think maybe are a little artificially priced in this cheap money environment, you know, we're willing to part with.
Right. Those are all very good points. I couldn't agree with you more on the recap and on the debt side, and we're seeing it on the bifurcated side as well, on the smaller assets, the you know, under 50 million, as people are looking to finance those, and they're just not, it's just not as efficient a market. There's not as many people playing in that space. So you guys can do it big, and obviously small, it's great. Chris, talk about you. Do you have any competition out there? Do you just buy indiscriminately? What's the, come on.
I want to invest with him. Yeah,
sure, we have competition. I mean, I think this year in new investment we'll do about, I think it's $3.1 or $3.2 billion of new investments this year. Something like 150 different properties. We'll also sell a little bit over $1 billion. And most of what we do is sort of single asset deals. And our asset classes are small. And in our opportunistic fund, it's 5-7 million equity checks per property. But we've had a couple, you know, we've had two big portfolios this year in which we've moved $1 billion. Each one was about a $500,000 portfolio. And there is competition, but one of the things that's been kind of fun that we did is we have our opportunistic fund series that just focuses on the special asset classes. We also created an open-ended fund. And that open-ended fund targets the same asset classes. So now when we go to an opportunity, we have the ability to bring multiple cost of capital. So we bought a large portfolio from a REIT, actually, out in the East Coast, a big portfolio of medical office buildings. It was about 22 assets, a little bit over 500 million, and we could parse up the lease-up assets, put them into our opportunistic fund. We could put the stabilized assets into our core fund. So that's been kind of a fun lever for us to pull because a lot of folks that are just focused on our asset classes either maybe just have an opportunistic fund or maybe have a core fund. But that's given us a little bit of an ability to differentiate our capital source.
Good. Well, one thing I always like to do is just talk about, you know, some real deals, some real investments that we've recently all made. And I think hearing about how we compete is helpful because I think, yes, story type opportunities, you know, allow you to kind of navigate in there. I also believe that having full discretion over capital and being able to move quickly is a real differentiator, and really having the history and the track record of being a closer. Because I think sellers, and we're active sellers too, you know, you have a lot of options out there about who to go with. And you don't want to have to sell something twice. And you know, we've all had that experience. You know, recently, I mean, it was pretty amazing. We have new appreciation for this now because in addition to doing commingled funds, we also do separate accounts for the first time. Mm-hmm. And I think we went into that with not, you know, a little bit of intrepidation because, you know, we weren't sure what that process would be. And I have to tell you, I've been so pleasantly surprised. And, you know, in mid-August, you know, we had an opportunity, you know, it was an under $20 million retail deal in Boston, 10,000 feet on Newbury Street, where an operating partner, a buyer, had it hard and under contract closing September 3rd or something. And basically his capital source flaked out. And we ended up moving in with a separate account, and much to my shock, we actually got it done and moved them along that process. And this was for an empty 10,000 square foot, you know, retail property in the heart of Boston's retail district. I mean, you know, block from the Apple store, no upside, downside, just level. You know, a spa had vacated. And this was a transaction where from a risk standpoint, it was more of a value add, but we kind of felt that, hey, you know, within 15 months, which was kind of our lease-up period, we'd get this thing figured out and leased. And, you know, we believe anyhow that given rents, you know, the return on costs, you know, would be something in the, you know, low sevens. And even if you do inflate, you know, residual cap rates and, okay, let's call it trading at a 5.5, you know, certainly a real opportunity there to make money. Again, not a huge transaction, but I think those kind of incorporate some of the elements that, you know, Len, you were referring to, as well as speed and certainty. So that's one way to kind of navigate, you know, this world of, you know, Roy March and his team heavily marketing transactions, you know, throughout the system, where you kind of say, wow, you know, do I really want to bid that last, you know, little bit because I might win it? So, you know, that's one example. I don't know, you know, I think people in the audience would love to hear maybe, you know, I mean, Ralph, you were talking about something you were doing in Midland, a development deal, or maybe you want to pick something else. But just talk about something specific. Talk about some of the risk and returns, how you think about it.
Sure. Our model is set up where we need to have one or a combination of the following: either a sourcing advantage, some type of informational advantage that we're getting from our portfolio companies or our credit portfolio or our macro team or our public affairs team, or some type of operational advantage. So unless we can sort of check the box on one or more of those attributes, typically we would conclude that we're just buying the market if we transact, and that's not what people pay us to do. So when Steve referenced this Midland opportunity that I have been talking about, we have a major oil and gas franchise at KKR. We see all the data that comes through all of our oil and gas operating partners, engineering staffs, in terms of how prolific some of the different basins are in the country. We have a development deal up in Williston, North Dakota, but just a couple weeks ago we closed on, call it, plus or minus 40 or 50 acres of land in Midland, Texas, where we are going to develop a Whole Foods anchored retail experience. And if anybody's been to Midland, Texas, there's a lot of wealth in Midland, Texas. We believe Midland, Texas will continue to grow. Between Midland and Odessa, the entire population's in the hundreds of thousands of people, and there's a lot of disposable income, and there just really isn't that, ironically, that much of a consumption-driven retail experience for people who have discretionary capital. So when you think about the risk return of what we're doing, we think we can create that deal to something like a 9 or a 9.5 unlevered. And even though cap rates, as we would all expect in Midland, Texas, are not the same as they are in Boston, Massachusetts, we think that if we create what I described, that you could, if you want, spin off the Whole Foods store independent and sell that at Whole Foods type cap rates, which are in the 5s, and keep the remainder and just refinance that, or sell the entire package somewhere, probably in today's environment, in the mid 6s, maybe as high as a 7, but if we can develop to a 9.5 and create something where the financing markets are quite efficient in Odessa, Texas, just like they're in Boston, Massachusetts, that feels like a good risk reward to us.
Anyone else want to talk about, Pam?
Yeah, I mean, just thinking through deals, we do a lot of different things, but I thought one deal that was interesting is a deal that we actually did in the past year, which is in suburban Boston. And I think we were able to take advantage of getting the deal. It was pretty heavily bid up, but we actually did it in our open-ended core fund that actually has a value bucket, and because it was a big deal. So a local operator couldn't really do it on their own, so we elected to team up with two of the best operators in Boston, National Development and Charles River Realty. Brian Kavujian may actually be in here. But what we did is we bought a 1 million square foot office park, which sits north of 128 for you that are familiar with the area, but obviously major highway in between Route 93, the Mass Pike, sitting next to the second largest mall in New England. And the property was built in the 70s and 80s and had been upgraded over time. But we bought the property for a low $200 a foot, which was about a 20% discount from what we consider comparable age property. And the business plan was to invest $26 million into the deal. About $14 million just to do base building upgrades and site plan, but the balance was to go through and add retail. So we plan to do around 40,000 square feet of retail in a couple of restaurants, sell off a piece of land to a hotel operator, take this tower building that was pretty ugly sitting on the freeway. We're actually going to take an entire wing off of the building and design floor plates that will be very attractive. We're also sitting next to the Leahy Clinic. So, I fast forward, we closed about July of last year. We've sold the land for a 170-room Marriott. We've already attracted a restaurant operator. We're going to rebrand, we're renaming it. And what we're trying to do is really create a buzz in the marketplace. And so it's a great example of an asset that really could fit in the core bucket because it was throwing off a 5.5 unlevered income yield. And if we put short-term debt, so it's really pushing about a 9.5% leveraged income yield for the first couple of years. And over time, if our underwriting works out, which I think it will, because we've already hit office rents that we projected we're going to hit in 2017, we'll end up getting about a 12% net return for our core fund. That's net of, promotes and fees to everybody. So for us, that's a great way to try to add some value in a core fund, which, as Roy talked about earlier, core pricing 6 to 6.5% unlevered IRR over 7 years.
How did investors in the core fund feel about
They love it.
profile of that investment?
They absolutely love it, because the reality of it is, even if we didn't do anything to it, we would have gotten about a 8% unlevered return. We got great financing, so we probably would have gotten to about a 10 net. So even in the numbers I'm quoting you, that doesn't even take into account kind of what we're seeing today, what we've actually done for leases on both the restaurants and the office and the hotel. That is what I would consider kind of our very base case without a lot. But I mean, it's really interesting in these core funds. I mean, there's a lot of our competitors that are doing full-fledged development in the value bucket of their core fund. They're doing mezzanine debt in the fund. So we viewed it and said, we've got very stable income in place, very diverse tenant base, and it's just a killer location.
It's not Unicorn Park, is it?
No, it's New
Okay.
England Executive Park,
Okay.
which was actually one of the first deals I worked on as an asset manager.
Good for you.
So, I mean, it's really, I mean, you can't beat the location. It was just sitting there very sleepy.
Sounds a great deal.
Well, we could keep going here for a while, but in case there are questions out here, I have a couple more questions to ask, but I want to make sure and open it up. We got about 10 minutes right there.
Question for Ralph and Chris. Money has flowed into opportunistic investments. What has happened to your targeted returns? Are you seeking lower returns now? What kind of returns are you seeking? What are your investments?
I think over time, each of our funds, when we look at the years we're raising our funds, we're certainly looking at what are the right expectations from returns. And we've seen different risk profiles with each of the investments. So student housing, when we used to do student housing, people were concerned about liquidity. Now there's much more liquidity. Cap rates have come down a little bit. But I'd say we never really quote returns by individual asset because the goal is to build a portfolio. But our opportunistic funds are mid-teens type funds, but we're looking for a decent multiple on the investment. And then we have an open-ended core fund that very typical sort of 8, 9, 10% kind of overall return, lower leverage. So the difference is the two buckets. One has lower leverage, but what we're finding in the core space, it's very interesting how other folks to get yield are doing a lot of spec development. It's fascinating. But the idea with the core strategy is to be more of a stabilized, low leverage product.
What we describe to our investors is that we're shooting to make at the asset level 16% plus returns at the asset level with no more than 70% leverage on average. So I would answer your question with that soundbite, but also if you peel back the onion, a lot of how we articulate in our own underwritings a 16 or an 18 or a 20% return, whatever we're looking at, is really how you think about the underlying assumptions that are driving those returns. Because we all know you can make the assumptions, create whatever returns you want, but almost a rule of thumb for us, for the most part, is we bet on cap rate expansion. We never assume that our asset is going to grow at better than the consensus market, whatever that particular market is, in terms of rental growth or occupancy, absorption, et cetera, unless we can really look ourselves in the mirror and say there's something uniquely differentiated about what we have relative to the quote-unquote market. And so when you sort of roll that all into the sausage maker, we like to believe that the return distribution that comes out of the modeling is not a normal return distribution, but really a return distribution where we feel that there's asymmetric optionality to the upside, where we've really protected our basis in the downside, and that with all these sort of realistic assumptions, that the base case is somewhere between a 16 and an 18 plus or minus % gross return.
Other questions out there? No? Okay, I always have one question I'd like to ask to wrap it up. Chris knows this one. Okay, so I have kids who are either going to college, in college, or just out of college. And the question is, so we think about this, is would you let your kids go into real estate? Why or why not? And take whatever risk factors, wrap it into it.
Both my kids are.
Okay, so
I
why?
told them not to. I just think that they love it. I mean, well, my son's in business school right now, but He was in real estate, worked for a senior housing company. My daughter works for a commercial mortgage company. I told them to go into technology. They just love it. But honestly, I actually would advise a kid to do it because even through, good markets and bad markets, real estate's really very exciting. I mean, you get to deal with the capital side, the investment side. You're dealing with great people. It has a lot of different facets to it. When you look at the demographics of our industry in particular, there's a lot of people who are 50 and up who are managing these companies. There's a huge gap between the 40 and 50-year-old. So there's tremendous opportunities for kids in our company who are in their late 30s. And so rising tides raise all ships. So I think it's a great business to go into.
Depends how strong they are in technology, right? If you can go invent something in software, do it. Otherwise, I think it's a good business. Both my kids went into more artistic avenues, but maybe I scared them away from it. But I think it's a great business. I mean, I would do it again. I think that's the first question. I had somebody ask me that question. If you were 22, would you do this again? And I think I would.
I think it matters what motivates you. I think from an intellectual stimulation perspective, it is quite an interesting business. There's never a day that I'm sure any of us have where you're not sort of solving a problem or trying to figure out some idiosyncratic answer to something that's going on at an asset level or in a capital structure, et cetera. So I think if the motivation is to be intellectually engaged every day, then I think that's a great industry to go to. I think if the motivation is to become independently wealthy, I would say that's a lot tougher in our business unless you want to move to, in my opinion, Williston, North Dakota, or to South Africa, or to some other emerging market where you're going to see real GDP growth and the evolution of capital markets to more institutional standards over time. So if your child was saying, I want to go become the next gazillionaire, I would say in the US, probably not a good idea. But if your child wants to be incredibly motivated and stimulated intellectually, I think it's a great industry.
Last word's yours, Chris.
Jay's going to
I have a while till the kids are working. My oldest just started high school, so I've got a little time. But it's been a great career for me. I've really enjoyed it. I think it's a great opportunity to get international exposure. So, for me, I was fortunate enough to be able to live over in London, work over there, and so I think it's a great career to get some global exposure. So that's kind of what my thoughts would be.
Well, hopefully the takeaway here was pretty hopeful panel about our industry and about where we're going, other than trying to raise your own fund. So please join me in thanking, because they were terrific, these 4 people.